What's the outlook for oil in 2026? A major shift is on the horizon. The market is bracing for a significant supply glut, which could push oil prices down. We're talking about Brent crude potentially hovering around $60 a barrel, with West Texas Intermediate even lower, maybe in the mid-50s. This isn't just a minor dip, it's a fundamental change driven by slowing demand growth and a surge in production. For investors, this new landscape raises a critical question. What does this mean for the major oil stocks? Are they still a smart play, or are we looking at a potential trap? Today, we diving deep into three oil giants you absolutely need to have on your radar for 2026 to see if they opportunities or pitfalls. First up, the Titan itself, ExxonMobil, ticker symbol ExxonMobil. After a tough period, ExxonMobil has staged an impressive comeback. Its recent performance shows a strong rebound, proving its resilience in a volatile market. What makes ExxonMobil so interesting for 2026 and beyond is its strategic pivot towards energy diversity. They're not just an oil and gas company anymore. They are heavily investing in low-carbon solutions, including carbon capture and hydrogen, positioning themselves for the future of energy. This isn't just about adapting, it's about leading the transition. Looking at their long-term performance, ExxonMobil has consistently delivered value to shareholders. While lower oil prices will certainly test their profitability, their diversified portfolio and forward-thinking strategy could provide a crucial buffer. The real question is whether their new ventures can scale fast enough to offset the potential weakness in their traditional oil business. It's a classic battle between legacy strength and future growth. Next, let's talk about Chevron, ticker Chevron. If you're looking for a company that has mastered the art of diversification, Chevron is it. They have a truly global footprint with operations spanning upstream exploration and production, midstream transportation, and downstream refining and marketing. This vertical integration gives them a significant advantage. When crude oil prices are low, their downstream operations, like refining, can actually benefit from cheaper raw materials, helping to stabilize their overall earnings. But what really makes Chevron stand out, especially for income-focused investors, is its stellar dividend record. It boasts one of the longest streaks of dividend growth in the entire energy sector. This commitment to returning cash to shareholders, even during market downturns, speaks volumes about its financial discipline and robust cash flow management. For 2026, the challenge for Chevron will be to maintain this dividend growth while navigating a lower price environment. Their diversified model is their greatest strength, but it will be put to the test. Finally, we have Occidental Petroleum, or OXY. This one is a bit more of a wild card. On the one hand, Occidental has been making big moves to increase its pipeline capacity, especially in the prolific Permian Basin. This expansion is designed to improve their efficiency and reduce transportation costs, giving them a competitive edge in getting their oil to market. More capacity means they can potentially increase production volumes to offset lower prices per barrel. However, there's a flip side. Occidental is more sensitive to oil price fluctuations than the super majors like Exxon or Chevron. The recent downturn in oil prices has already put pressure on their production plans and profitability. Their high debt load, a legacy of a major acquisition, makes them particularly vulnerable in a sustained low-price environment. So, for Occidental, 2026 is a race. Can their strategic growth in infrastructure and efficiency outpace the negative impact of falling oil prices? It's a high-stakes play that could offer significant rewards, but it also comes with a higher level of risk. So where does that leave us? Are these oil stocks opportunities or pitfalls for 2026? The answer, as always, isn't black and white. For investors seeking potentially stable income and long-term value, giants like ExxonMobil and Chevron offer compelling cases. Their diversification, commitment to dividends, and investments in future energy technologies provide a solid foundation. They represent opportunities for those with a long-term horizon who can weather market cycles. On the other hand, the looming supply glut and projected lower prices create real pitfalls. More specialized players like Occidental Petroleum face greater risks, and even the super majors will feel the pressure on their profits. The key takeaway is this: the oil sector is in transition. Success in 2026 will depend not just on pumping oil, but on financial discipline, strategic diversification, and a clear vision for a lower carbon future. As an investor, You need to decide if you comfortable with the volatility or if you looking for a smoother ride elsewhere. Thanks for watching. Don't forget to like, subscribe, and hit that notification bell for more deep dives into the market.